Hello and welcome. My name is Eileen Ortega. I am a partner here with Fortress Wealth Planning and wanted to come to you today to bring you some updates on estate planning, tax planning, and just generally post-election updates as related to overall uh, financial and estate planning. So we are all inundated with noise in today's news cycles and social media, etc. And it's so important that we truly understand what is actually in place today, what are the potential changes on the horizon, and how does that impact us short and long term. And we see our role and truly take it seriously to educate and provide transparency so that you are armed with information to make the best planning decisions for your family. So as many of you know, the Tax and Jobs Act, or the TCJA, enacted during the last Trump administration in 2017, introduced significant changes to tax and estate planning policies, among other regulatory measures. Currently, the incoming administration has expressed their absolute intent to extend the provisions of the Act before it is due to expire later this year. A few of the most impactful changes made in the way of estate and tax planning included charitable giving deductions and lifetime estate and gift tax exemptions. So in terms of charitable giving deductions, the ceiling for charitable contribution deductions on an individual's tax return was increased to 60% of the adjusted gross income in a given year for cash donations from a prior deduction ceiling of 50%, so an increase of 10%. And this could have significant impact on those who regularly gift to charitable organizations, either directly or through other sources, such as a donor advised fund. Those with significant assets included in their gross estate, meaning the total value of all assets owned by an individual at their passing, which would include any cash, investments, real estate, jewelry, personal property, life insurance policies. That makes up your gross estate. And so those with assets included in their gross estate at their death could be subject to a 40% death tax for all assets in excess of the lifetime exemption amount. And what that means is, the IRS has set a limit, and anything above that limit, which increases each year incrementally, every dollar above that limit is taxed at nearly 40%. So the TCJA in 2017 increased the lifetime exemption by nearly double the previous amount. So it went from $5.5 million to approximately $11.2 million. And then in 2025, since it was incrementally moving up each year with inflation, the limits are currently sitting at $13,990,000 per person. Now, whether the TCJA expires or not, those with assets, significant assets, should consider annual gifts either at or below the annual exclusion amount, which the annual exclusion amount means the amount that you can give to any individual and not be required to report that gift on your taxes. That amount is $19,000 in 2025. You can gift it to an unlimited amount of individuals. If gifting cash is a concern, maybe due to potential mismanagement by a beneficiary, there are other ways that those gifts can be made, either through contributions to an IRA for their benefit, an HSA or health savings account, to a trust for their benefit, or even gifting securities in kind that can remain invested and held in their individual name. Another way to really take advantage of getting assets, moving assets out of the estate are and use of an irrevocable life insurance trust. So in this case, the trust would hold a life insurance policy on the life of the grantor. The trust actually owns that policy. Gifts are made to the trust and the premiums are paid. And so that when the grantor passes, the death benefit then pays into that trust and is not included in the gross estate. So it passes that face value of the policy to the heirs free of estate tax. If there is insurance already in place, it can be retitled into the name of that trust relatively simply, and could accomplish a significant estate tax savings. And in this case, the assets are distributed in accordance with the grantor's wishes, which are outlined within that trust agreement. Another strategy might be what's called a spousal lifetime access trust. And this is a situation where one spouse gives assets to the other. Typically, you'll try to maximize the lifetime exemption amount, so that $13,990,000. And the assets are then placed into a trust of which the spouse is the beneficiary. And the spouse then has the right to use those assets for both themselves and their spouse. So the actual grantor or spouse who made the gift into the trust. Assets in each of the trusts, if you were to do a spousal lifetime access trust for each spouse, it would not be included in the other's estate for tax purposes. Now, when moving assets between spouses before gifting to a trust, you want to make sure of a couple of things. Gifts of cash. The recipient spouse should consider investing in securities or buying something for themselves before making a gift, so that it's really demonstrating, it's obviously they have control of the funds. Gifts of real estate, you probably want to wait 6 months before the recipient spouse makes a gift, considering like remodeling as part of the property. Waiting to initiate a gifting strategy until later in 2025 could really tighten the time frame to complete gifts. So it's important that while we do have this sort of expiration on the horizon that we think it might extend or continue, we just don't know. And so being proactive in making decisions for these strategies while still adhering to the intent of the estate, I think are very important. Transfer tax strategies that individuals should consider continue to be really wealth transfer. Analyze and reviewing gifting strategies is important, to make sure that you're not impacting or negatively impacting your own situation, but really looking sort of forward and almost pre-funding what the ultimate estate plan is meant to do. So one key factor in this is taking appreciation outside of the estate and moving it sort of to the next generation. So funding trusts with assets that are expected to appreciate, maybe in a period of a downturn in the market, there is an opportunity to get sort of depressed assets out of the estate, move them into a vehicle that is set up for the benefit of the next generation, and letting all the recovery and the growth happen outside of the estate. As a rule of thumb, $10 million, for example, earning approximately 7% a year, doubles every 10 years. So if we think in terms of the next 30 to 50 years of our lifetimes, there are significant compounding that's going to occur and that can get significant growth outside of our estates. Some other strategies to consider really as related to charitable planning, and it's important to note that charitable planning should be done for two reasons. A, to fulfill an intent, either to, um, you know, carry philanthropic goals through the family, to maybe include other family members in that giving, to really just take advantage of tax planning while at the same time benefiting your charitable goals. But it's important to not make those decisions in a vacuum, because you want to make sure whatever strategy is chosen in effect doesn't put your situation at risk. So some examples of how one might fund a charitable intent while still taking advantage of both income and estate tax planning. One example is a charitable remainder trust. So in this case, the grantor donates assets to the trust. The assets are held in that trust. There is a fixed amount that is outlined by the trust agreement that pays out to the beneficiary each year. So for example, a charitable remainder trust is funded with $500,000 and then pays out a fixed amount of 5% per year for the remainder of the lifetime of the current beneficiary. Oftentimes it's the grantor themselves that are the current beneficiary. It could be a spouse, could be another family member. But for their lifetime, it will pay out that fixed amount. It's invested, so it's hopefully growing more than the distribution amount. And at the end of the life of the beneficiary, the remainder of that trust would pay to charity. Conversely, a charitable lead trust reverses that distribution plan. So the grantor would donate assets to a trust, designate a charity as the primary income beneficiary to receive that fixed distribution each year. Typically, it's a percentage of the assets. And then the trust is set up in this case for a period of time. So whether that be 10 years, 15 years, etc. When that period of the trust ends, whatever the remaining assets are then transferred to the heirs of the grantor. So all of that remainder will be outside of the estate of the grantor, and they will have achieved both charitable benefit and moving assets outside of the estate. So the key benefits in both of these options are that you receive a tax deduction for gifted assets, and that is an income tax deduction. In the case of the charitable remainder trust, you receive an estate tax deduction for the remainder amount, the expected remainder amount in the trust at your passing. And you avoid capital gains taxes, because any highly appreciated assets that are transferred to a charitable trust and then sold, the grantor does not realize those capital gains. So you both minimize gift and estate taxes in that case. Some other vehicles that can be used are donor advised funds, which we mentioned earlier, and private foundations. Donor advised funds are essentially a fund that can be used as even a family charitable fund, bringing the family together to fulfill that philanthropic goal. Gifts to that donor advised fund, the grantor gets a tax deduction in the year the gift is made. There are no required distributions from the donor advised fund, and the assets can then be invested through an investment advisor. And ultimately, when the decision is made as to which charities you would like to make distributions and to benefit, at that point you can make those distributions, though they can be made to only 501c3 charities only. With regard to a private foundation, again, a tax deduction is realized in the year the gift is made, but there is a 5% required distribution annually. Assets can be invested either with an advisor or under the control of the grantor, and there's a little bit more flexibility when it comes to donations. So again, these are just a handful of strategies that can be used. We are always available to talk through different goals, different strategies, and explore the most beneficial approach for your situation. Should you have any questions regarding the information I've just shared, please don't hesitate to reach out, or if we can help in any other way, we would be happy to. Thank you so much. Have a great day.